Joyce, what do you make of these relatively benign economic signals when you contrast it with the transports with their worst week in several years, for example?
Well, I think you have a couple of factors in place. You have poor market liquidity. You also have concerns about the geopolitical noise, with much of that focused on the U.S.-China relations. Will a meeting take place this week? Will you actually see any concrete announcements come out? And then you also have the Brexit noise. So you've got a combination of geopolitical risk and market liquidity concerns that are really weighing on the market right now.
Which is the most important to listen to?
I think the geopolitical risks are the ones that are going to guide the market this week. But the market liquidity, hopefully, we think is signaling actually quite favorable positioning that points to the market turning upwards. Now, overall growth, we still think remains above trend in 2019. We've at just shy of 3% at 2.9% growth. So it's not the growth story or the fundamentals at this stage. I think it's right now confidence that the market is looking for.
Shawn, it sounds like you have a different view of the situation. You think the market's going to peak next year?
I certainly think when we look at the marketplace, it's really a credit bubble in some ways, right? So we've had this massive amount of leverage created in the system that has to come out. And as we think about the world, we've had a credit bubble after credit bubble the last 20 years. So this is not unlike what's happened in the past. Now, it's not going to be as bad because you don't have the same type of leverage characteristics, but certainly corporations have significant amount of credit on their balance sheet, and there is a fair amount that are going to have a tough time rolling their debt at some point in time in the next couple of years.
Are you worried about credit spreads then? Are you seeing any signs of weakness that concern you in the credit markets?
Credit market is definitely starting to see some concern. I think you'll probably have a tradable rally in credit here at some point because people are going to move out of the equity market and they're going to look for safety. And we've been conditioned that cash is not an asset class, which is crazy. I think cash is a great asset class at this point in time, but most people have been conditioned that it's not an asset class. So in effect, people will start to look to go up the cap structure and they'll go into credit. I think that is a bad trade because certainly I think in the second half of next year, there are going to be problems in credit.
Citi has a note out. A narrative of vulnerability will pervade the U.S. corporate bond market in 19 as an array of mighty U.S. non-financial companies take their turn in the barrel. Does that sound right?
Well, I do think you're going to see more ratings downgrades next year, but I don't think the rollover problem is that big in 2019. Now, as we look to the second half of 2019, if Fed policy becomes more restrictive, if the recession risks rise, but right now the immediate indicators are pointing to an excessive pricing of risk premia at this stage, in our opinion. But you will see ratings downgrade. The leverage has not built up at like 2008 levels. We think the rollover needs are manageable, but you're going to see the underperformance of credit, I think, continue into next year. I do think that cash is going to outperform credit next year.
So is your view, Joyce, that the stock market is overreacting to some of the negative signals that we've been getting lately?
The stock market is overreacting. We still have earnings growth for next year at around 8%, but they're looking for positive momentum and catalysts. So the trade, the trade discussions with China are front and center for this week's news. Also, the Friday prints and how they come out. But I think market liquidity has been driving a lot of the stock market volatility.
I mean, Shawn, 2 weeks ago, everyone was talking about rate hikes in December and a few next year, 2 to 4. Now the chatter is maybe one and done. Maybe we'll get a pause from the Fed. Doesn't that change the entire outlook on the markets next year?
Well, not really. I mean, certainly one and done is because the demand picture isn't as good. So if we think about the world, they're doing it for a reason, right? And again, I think it goes back to credit. And I think credit is going to be the key component. The two things that have to really happen for the economy to do well and certainly for the equity market to do well, productivity has to go up or perception productivity has to go up. That has to be a story that continues. And credit spreads have to normalize here at some point so people feel comfortable that they can get back into the marketplace. And look, I think there are going to be tradable rallies here and there, but certainly the theme is in place for the next year or two.
All right, but I want to explain to me why you're worried, because I haven't actually heard the reasons underlying your concern for credit.
For credit? I mean, certainly you look at 35% of the companies that are out there aren't making any money. They have debt in position. It's going to be tough to roll. Again, when you think about it, duration is a significant part of a corporate balance sheet that no one actually thinks about. So we had rates back up. Certainly from the lows, we had them back up 150 basis points, so that's an issue. Credit spreads were incredibly tight because rates were incredibly low, so there's correlation there as well. So if we think about high yield, which is certainly a place where at some point in time in the cycle, it becomes an equity-like investment.
Yes.
that hasn't been thought about for years and years. And then we get into the leveraged loan market, which is actually bigger now than the high yield market at this point in time. And there's more leverage there than there is in the high yield market. So effectively, you have a really levered environment that was caused by low interest rates.
Is that more of a Russell story, though, than an S&P story? Given the number of companies that are, say, tied to LIBOR or something like that?
It certainly is, but you still have 18% of high yield is an energy complex, right? So that becomes a problem as energy prices go down. It just infects itself, right? As we think about credit is something that once it starts to lose confidence on the lower rung, it slowly moves higher, right? And that becomes an issue. So you're going to be paying more for your debt no matter what, and it's going to be harder to come by.
Finally, Joyce, on the Fed. A couple months ago, they said it was an extraordinary moment, that it was almost too good to be true, as Powell said. Has their credibility taken a hit or not?
I think that you should still expect the Fed to hike here. I mean, because the fundamental indicators really haven't shifted that much, even though sentiment has shifted. So I don't expect the Fed to pause at this stage in the game.
But financial conditions have tightened so much.
Financial conditions have tightened so much, but you're also looking at just the length of this expansion. It's the longest expansion since post-World War II history, but also just shy of the longest since 1860. So some market correction isn't that surprising. I do think some of this is technically driven, and the fundamental data that's coming out really has not shifted as much as the sentiment.